asset management chief investment strategist, Joseph Tanious. He's got $1.4 trillion in assets under management. Between the U.S. and Iran and the mixed messaging of we have a 15-point deal, they've got a 5-point deal, we don't have an end to this war just yet. How do you read this market?
Well, I think we're all just inundated with headlines here, and unsurprisingly, the market's reacting just on a whim based on all of this news. You've got some encouraging news, some hopeful signs that perhaps there is going to be an end to this conflict. We are going to find an off-ramp, and then, of course, reality sets in, and we hear that's not necessarily the case.
But you look at kind of a healthy Dow heat map. And you look at some of the leaders here. Sherwin-Williams is in the top pole position for the heat map. And then you follow with Honeywell, Merck, Johnson & Johnson. And so my question to you is, what area of the markets looks good to you, considering we've got a panoply of different leadership names here?
So I think there are a few things we have to acknowledge and recognize. One, if you have higher oil prices, higher energy prices, all else equal, that's bad for economic growth, obviously, and that creates some inflationary pressure. Mm-hmm. But the second thing we have to acknowledge here is that it's going to disproportionately affect different economies and different regions around the world. You take the United States, for example, we're certainly not immune to higher oil prices. But the U.S. is, in fact, a net exporter of energy into the world, whereas if you take a look at Europe, you take a look at Asia, that isn't so much the case. I think what you're seeing is any sign of an off-ramp from the U.S. and potentially a bounce back in U.S. risk assets. And that's part of the reason why you're seeing so much green today.
You got two-way volatility, though, with these headlines. 1 minute volatility is spiking. The next, that fear index, the VIX, is dropping. And when I was just looking, I mean, today it's down. At least it was a few seconds ago. But again, it's really hard to tell with volatility. Yeah, it's still down about 4%. But month to date, up 27%. This has been a rough month. The war started at the very end of February. Year to date, up 69%. Mm-hmm. So it's a bit of a dangerous time for investors. Is it better or not to just hold fire?
I think you have to first recognize that we don't know exactly how this war is going to end. We don't know the end game here, right? Our base case scenario is that the U.S. economy does avoid a recession. We also have increased our recession probability odds to 30%. But our base case is that we have an expansion. You still have fiscal stimulus coming through the form of the One Big Beautiful Bill Act, right? That's going to be a nice tailwind to economic activity. We still believe you're going to have an accommodative Federal Reserve, maybe only one rate cut this year rather than two.
Can I hold you on that? Accommodative? There are now indications of a rate hike possibly coming in both September and December. And some of that, I think you really have to look at and say it ties to diesel prices. It ties to gasoline prices, because that means if we can put up diesel and how it has jumped so dramatically. And to me, that's an indication that there is the belief that consumers will need to be spending more on gasoline, on diesel. Look at diesel. A month ago, $3.74 a gallon. Today, $5.36 a gallon. That's average. You know at some point that's going to be passed through the supply chain to the end buyer, a consumer.
Without question. And I think right now for the U.S. economy, we're dealing with two challenges. One, you have a shock to inflationary prices as a result of tariffs. Mm-hmm. Obviously, that's something we were expecting before this conflict. And now, two, you have this oil price shock, and that's also feeding through to inflation. You have to take a step back and ask yourself, though, what control does the Fed, what control does any central bank have with respect to these two shocks? So long as inflation expectations or long-term inflation expectations remain anchored, I suspect the Fed is going to look through that.
And you think they are remaining anchored. Just to say, there was another headline today from the Wall Street Journal that the U.S. Postal Service is going to impose their first ever fuel surcharge of 8% on packages. First time ever, because the gasoline it takes to propel the trucks and the jets that have to move around.
Higher prices everywhere, right? We're also seeing it, you're hearing about from the airlines, right? As it costs them more to fill up their engines, if you will, their fuel. And without question, when you have higher energy prices, remember, it's not just oil, but you also have the byproducts of liquefied natural gas, the impact that has on fertilizer, on ammonia, on so many other things, and how that trickles down into the supply chain. You're ultimately going to see higher prices.
Joseph, let's leave our viewers with some ideas here. You have reduced your exposure to developed country investments, ex-U.S. Aside from that, where are you adding?
You know, we want to continue to lean into the markets that we believe are poised to rebound sharply. once there is an end to this conflict. And when we look at it from a regional perspective, all eyes point to the United States from a relative perspective. We also want to continue to have some exposure to infrastructure, to natural resources, to real assets, as these are things that have done well, obviously, in the midst of this conflict. But over the course of this year, as the long-term impact of this conflict sort of trickles through into the economy, they should also continue to benefit.
Well, so do you avoid consumer discretionary? What do you look at staples? I mean, today, consumer discretionary up just 1%. We could stretch it out and you can see all of what's happening there.
I think generally speaking, given the market dynamics and the volatility, which you just pointed out, and the expectation that volatility is probably going to remain elevated, leaning into the more defensive sectors of the market probably make a little bit more sense. So I'd look into consumer staples, for example, utilities, these areas of the markets that are going to provide a bit more protection and lower beta.
All right, go back to your $1.4 trillion in assets under management. You've got some trading to do here. Good to see you, Joseph.
Good to see you too. Thank you.
Thank you.